Most people have heard about trusts, but very few people have heard about testamentary trusts. What is a testamentary trust? It's a clause inserted in your will. Testamentary trust only comes into being when you die. What it does primarily is protect your beneficiaries and give them outcomes to save tax. If you pay money out of a trust to a child, you're paying tax at a penalty rate. However, if you pay a child money from a testamentary trust, they're taxed as adults. So if, for example, grandma passes away and the will to you and your family is in the version of a testamentary trust, then you can make allocations of income from that testamentary trust to children or grandchildren that are under 18, and they don't pay tax as children, they pay tax as adults. Very important for tax planning. Sadly, sometimes people die a lot younger than they expect and they've got a young family. Now, if you set the will properly with this testamentary trust, you have the option to have that money be put into trust, which your wife or your spouse can control for the benefit of your children, and therefore you could have this great tax benefit where your kids, as they're growing up and you're paying for school fees or you're paying for other parts of education, they're not paying tax on the first $20,000 of income. If I find a client that hasn't got a will or has a will but this clause is in there, it can be possible to actually create the testamentary trust after death, because if it's benefiting the children, then that can be something that can go through. I've seen this occur. So not gospel, got to check it out by a lawyer.